All right. Welcome to webinar number 20. This is webinar number 1 of this bad mustache I have going on. For those of you that watch our little Monday videos that we put out, it's just for the month of November. Supporting a good cause, which is called Movember. So month of November, it's just a men's health awareness fundraiser. So Patrick, his mustache just takes a while to maybe come in. You're a little behind.
I'm all eyebrows above the neck. Just no other hair grows. Doing my best, but it'll be here right when it's time to shave it.
Yeah, that's perfect. So 2021 year-end tax planning. Patrick, by the way, if you have questions or having problems with technology, feel free to reach out to him. He'll be. Are you on the info email?
Yeah, I got an eye on the info at Oceanside. So info@oceansideadvisors.com. Keeping an eye on that if anyone's having trouble. Can't hear Johann, picture goes out. Shoot that email a quick message. I'll see if I can help you out.
All right. So
we'll be taking a handful of questions at the end. I don't know if Johann mentioned this already. There's a little Q&A button at the bottom of the screen. If you want to write anything in, I'll be keeping an eye on that too, and we'll answer a couple of those before signing off here.
Perfect. All right, quick disclaimer. Through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. The information provided is for informational purposes only and does not constitute financial, tax, or legal advice. Of course, we like giving this advice, but we need to know you and your individual situation before we can do so. So the next half hour or so is purely educational, and hopefully you find it helpful. So our goals today. Understand some tax planning strategies available for individuals in 2021. Now, we were really hoping that the final bill, what they're calling the Build Back Better America Better Act. Now that Congress already signed the infrastructure bill. Most of the tax changes are coming in this next proposed piece of legislation, which is not yet finalized. We were really hoping that it would be. With that being said, the new bill, which the current draft of the bill doesn't have near the some of the more drastic changes that the original draft had. So for most people, there shouldn't be a great deal of change. So I think that's a good thing. With that being said, even without any change, there are a number of tax planning topics that we want to touch on today for your consideration and for you to work with your financial and other tax professionals to work out between now and the end of the year, if you haven't already. So we're going to start with this, a one-slide crash course on how my taxes are calculated. I find that a lot of people that we work with, you have that Form 1040, and you have Schedule A's and Schedule 1s, and many times your tax return might be 40 or 60 pages, and so I'm going to do my best just on one slide to show kind of the main points of simply how your taxes are calculated, because without understanding that piece, it can be pretty difficult to get into some of the more complex topics that we're going to touch on today. So For many of you, that will be a review. For others, you might find it kind of helpful. So we're going to do a very quick one-slide crash course on how my taxes are calculated. From there, we're going to discuss some specific tax items for 2021. We will then touch on some ways that you can reduce or try to reduce your taxable income for this year. And believe it or not, sometimes individuals might want to increase taxable income in this year. And we'll talk about some reasons why and how you do that. All right, so how are taxes calculated? All right, so we're going to start at the top. This is one slide. This by no means is exhaustive at all. This is very, very simplified, but hopefully it makes sense. This is best effort. So you start with gross income. Okay, so these are things like a W-2 if you're employed, maybe a 1099 if you're an independent contractor. Parts of your Social Security will be taxed. Pensions are taxed. If you're self-employed, you might have a Schedule C, maybe a K1, okay, some kind of partnership. So it's obviously going to start with gross income. Okay, so these are all your income sources. The next step, you need to subtract what's called deductions for AGI. All right, sometimes this is referred to as above the line deductions, if you've heard that phrase, above the line deductions. So what are some of these? Things like IRA contributions, HSA contributions, depending upon certain income levels, student loan interest can be included here. Okay, so gross income minus your above the line deductions for AGI, and this is where we arrive at adjusted gross income. Okay, many times referred to AGI. Okay, adjusted gross income. I have stars on the sides here because this is a really important number. Okay, it's important to distinguish that this is not your taxable income, but this is your adjusted gross income, and this is a really important line on your return because this number can determine like what tax credits you're eligible for. Are you eligible to contribute to a Roth IRA? Certain medical deductions are going to be based on this number. What you pay in Medicare premiums is slightly a big part of it's based off of adjusted gross income. So a really, really important number to focus on. All right. And then from there, once you have adjusted gross income, we are going to subtract the larger of a standard deduction or an itemized deduction. All right. So this is one that a lot of people get confused on. Some people think you could take like a little of both. No, like you only take one or the other, and it's the larger of the two is the one you're obviously going to take. So standard deduction for the year 2021, if you file your taxes single, $12,550. Those of you that file married filing jointly, $25,100 is just the standard deduction that you get, right? So even if you have no other deductions, like you get that deduction right off of your AGI, your adjusted gross income. Important to point out that if you have reached that fund Medicare age and you have that red, white, and blue card, if you're older than 65 years old, you get an additional $1,350 for each individual, right? So for couples, that's $2,700. All right, so that's the standard deduction. So you have standard deduction, or if the sum of these components, these are the primary four. These are the big four. Now there's some additional ones that get added into itemized deductions, but these are the main four. So if you have mortgage interest, right? So on your home, or a second mortgage, any kind of mortgage interest that is not considered basically an investment property, You get to include as an itemized deduction medical expenses that exceed 7.5% of your AGI. Again, that's why this AGI number is important. Okay, any medical expenses in excess of 7.5 of your adjusted gross income is included in your itemized deduction. State and local taxes, okay, so income or property taxes, and that is currently capped at $10,000 is the most you can write off for state and local taxes. That's one of the pieces of legislation that's up in the air. We'll see what the final bill says, but for now that is capped at 10,000. And then lastly, charitable contributions. So any, tithing to your church, giving money to the Red Cross, any 501c3 organization. So you have the sum of these four components, right? So if the sum of these four components is larger than your standard deduction, you'll see on your tax return, you'll take the itemized deduction over the standard. Obviously, you want the larger of the two, so your taxable income is lower, right? So gross income minus deductions for AGI gives you your AGI, minus the highest deduction you can get gives you your taxable income. All right, so your taxable income, this is where you go to like the schedule where it shows, okay, given this amount of taxable income, you're in the 12%, right? So you pay this amount up to a certain income level, and then you pay 22% on that next chunk of income, maybe 24 on the next, depending what your taxable income looks like. But there is a tax schedule that's very easy to look up, see what tax you pay. Okay, so once you have that tax, for a lot of people, you're not done yet, because then you have tax credits. Okay, so some example of tax credits, and again, this is not exhaustive. There's many more, but things like child tax credit, which for certain income levels, that was expanded in some of the coronavirus relief acts in the past year or two. There are solar credits, child dependent care credits, care for the elderly if you're taking care of an elderly mom or dad. There's education tax credits. So there are a number of credits that may or may not be eligible to you, given your situation and different income thresholds. All right, so after subtracting the tax credits, that's where you get down to the part of your return. It's page 2 of the 1040, where it says, all right, these are the withholdings that I've withheld throughout the year. Is it enough to satisfy the final tax? And if you've paid too much, you get what's called a refund. If you haven't paid enough, you get to write a check to the United States Treasury and settle up with the IRS. Maybe a penalty if you underpaid a little bit, which happens from time to time. But in a nutshell, this is my best one-page effort to try to explain a very complex concept. So hopefully that helped some. Okay, so when we look at kind of back to the tax schedule, okay. Some people like to look at it kind of as a matrix where it's like, income up to a certain amount, you pay this. We like to look at it, I think just looking at it in a fashion like this, just visually it helps. So we call this a tax map. It's the exact same idea, but it just illustrates how as your income moves higher, you start moving up the ladder into higher tax brackets. Okay, so this is ordinary income. A lot of people don't know that it's a different tax map for capital gains, right? So this is capital gains tax bracket. So you have 0, you reach a certain income level, 15%, and then higher up, it jumps up to a 20% long-term capital gains and qualified dividend tax rate. Okay, so just a couple specific items for 2021 that are really important to address. First off, if you've missed the memo, required minimum distributions for IRAs are back. Okay, so if you recall in 2020, the IRS, again, part of the Coronavirus Relief Act, nobody was required to take minimum distributions last year for IRAs. For 2021, and there were some rumors that maybe they would waive the requirement for 2021. They did not do that. So required minimum distributions are back. Okay, very, very important that if you have not taken your required minimum distribution, that you address that between now and December 31st. It remains the strictest penalty in the tax code if you miss it. Okay, so if you fail to take out the proper amount for your required minimum distribution, it's a 50% penalty, 50. Really harsh penalty. So please ensure that you've taken your required minimum distribution. So it's not just for traditional IRAs, but also inherited IRAs. All right. So if you are, and I want to make sure I separate the two. For your own IRAs, okay, for your own IRAs, if the way it stands now, current legislation, age 72, okay, if you are 72 years old or older, or you're about to turn 72 between now and December 31st, you are required to take a distribution. Inherited IRAs, of course, it's kind of a little more difficult to explain in the webinar today, but basically, if you were taking a distribution based on your lifetime before some of the recent legislation, where now it's kind of a 10-year rule, but just consult with your financial tax professional, make sure that you are taking inherited IRA distributions as well. Okay, so another small change from 2020 to 2021. So this year, so going back to that standard or itemized deduction. So if you recall, charitable contributions are a part of itemized deductions. Okay. However, I think Congress, they wanted to incentivize giving for the many people that take the standard deduction. So what they did, this year, it's $300 per person. So if you're married filing jointly, it's up to $600, where it's you actually receive the above the line deduction. Okay, so last year in 2020, it was only $300, whether you filed single or married filing jointly. So this year, $600 above the line deduction. Again, so that's the deduction above AGI, which is really, really helpful for a number of reasons. So if you are on the standard deduction, you think you will be for 2021, and you are charitably inclined, just know that you have that deduction available to you as well. All right, so why might I want to reduce taxable income in 2021? All right, so obviously we primarily deal with retirement planning. So for a lot of the retirees that we're helping, Medicare is a big concern, right? So Medicare premiums, once you reach certain income levels, your premiums are based on your income, right? So many times reducing your taxable income can mean lower Medicare premiums for Part B and Part D. Those of you that maybe you haven't reached that golden age of 65 and you're on, Affordable Care Act, so-called Obamacare insurance, trying to bridge that gap between, maybe when you retire and you're not yet 65, those subsidies are also income related. So many times reducing income means you get a larger subsidy to help you pay for that health insurance. Pay less tax on Social Security income. The way Social Security taxed is, the way it is taxed is pretty complicated. If you're interested in learning, I believe it was webinar 3, either webinar 2 or 3. It's called Taxes in Retirement. You can go back and watch that webinar if you're interested. But the formula, how Social Security is taxed, is it's based on the ratio of your other income to your Social Security. So by reducing some of your other income, many times your Social Security tax goes down as well. So that's a good reason. have the ability to contribute to a Roth IRA, right? So many times we'll see people that are, right up on that edge of whether or not they can contribute to a Roth IRA. And if you, take a couple steps to try to reduce income, it may allow you to be able to contribute to a Roth, which is really helpful. The ability to deduct traditional IRA contributions is also based on income. There's also a 3.8% net investment income tax. Okay, that tax is used to fund the Affordable Care Act. So that's based on income levels. Many times you can avoid that with some tax planning. And then the last one's pretty obvious, but just pay less in taxes, right? So a lot of considerations here on why you might want to reduce your taxable income in 2021. All right, so how do you do it? Well, if you're still working, the easiest way to do it is just to contribute to retirement plans. Try to max out retirement plans if possible, right? So if you have earned income, you might be offered a 401k at work, 403b, 457, traditional IRA. Maybe if you're self-employed, it might be a SEP IRA or a simple. So contributing to retirement plans is one way to do it. One area that is commonly overlooked, contributing to health savings accounts. Right now, your health plan, your healthcare plan needs to be a high deductible healthcare plan and able to, in order to do this. But really not. I mean, if you're paying for it out of pocket, it's fully deductible. All right, so many people forget that, or to tell their CPA that at the end of the year. So money in an HSA can be really helpful. Contribute to 529s for kids, grandkids. Now, important sub bullet here, like in the state of South Carolina, you get a state income tax deduction. That's not the case in every state. So I know we have some attendees today that are out of state, so certainly check with your own state on that. But in terms of reducing state income tax, 529 plans are a nice option. Okay, you can tax loss harvest your taxable accounts. We're going to go into that more, I believe, on the next slide. You can look at bunching itemized deductions. We have a slide on that as well. And then lastly, using qualified charitable distributions from retirement accounts, which that will require a slide to discuss and share that as well. All right, so we're going to start with tax loss harvesting. So taxpayers can deduct up to $3,000 a year in capital losses from non-qualified accounts. All right, now, importantly, you have to realize, or in other words, you have to sell that losing position in order to receive that tax treatment. All right, so I created just a very simple hypothetical example. Here are, let's say this is Jane's non-qualified account. These are the 5 positions that she owns. And so obviously there's one position there that's going to stick out to you. Okay. If this is 2021 and I would be willing to bet that IJDX was some kind of bond fund. Of course, these are all just made up. I just wrote these in, but obviously with interest rates going up, some fixed income positions are lower year to date. So maybe Jane's only loser in the portfolio is this fund. Okay. So again, if the loss is just on paper, like it's you aren't going to realize it and reap the tax benefit. Okay, so important, you have to sell that position. Okay, so you have to sell that position, which means you realize the loss. Now, when you sell the position, you want to go and well, most of the time you want to go and you want to buy a new position that is not identical to the same position. If you buy a position that is very similar to this one, you get what's called a wash sale. Okay, that's just a fancy phrase. The IRS says that they're going to disallow your loss. Okay, so you sell the position, realize the loss, you buy a new position that's not identical, or the worst thing you can do is just buy the same position back. That guarantees you a wash sale. And then so what would happen here is this taxpayer would receive $3,000 above the line deduction, okay, for 2021. Again, that's the most you can deduct. But it's a nice number though. $3,000 you can take right off your income, and then that remaining $590, that's going to carry over on your Schedule D as in dog, to the 2022 tax year. So tax loss harvesting is a really nice strategy. So we always look, well, so just to rewind 1 year, like the best time to do tax loss harvesting was right when COVID happened. So in the clients that we help, like we were doing a lot of this selling like March, April of 2020, because you get to realize all these losses. And even if you only get to deduct, 3,000 in that year, we have some carryover losses that come into 2021, right? So if you don't have a big crash, like we haven't at all in 2021, the best time to do it, we look at every client account at the end of the year, and we just look for, hey, maybe there's a single position that's down, right? So like this year, again, as I alluded to, some of the fixed income positions, given that interest rates have trickled up a little bit, right? So bonds and interest rates have an inverse relationship. So many bond funds, at least this year, are a little bit lower. So that might be something to look at in your account. Again, it has to be a taxable account, so it can't be an IRA, Roth IRA, but something to consider and looking into your own portfolio. Okay, bunching itemized deductions. Okay, so the Tax Cuts and Jobs Act 2017, which went into effect 2018, it changed the standard. It basically doubled the standard deduction, right? And so going back to our one-page tax calculation slide, remember, you can only take the higher of your standard deduction or the sum of the itemized deductions, right? So given the new rules, it's estimated only 12% of taxpayers now claim itemized deductions. So what that means for a lot of people is, your state and local taxes, your charitable giving, mortgage interest, like it ends up not being deductible, right? So one strategy to consider, and this works really well if like your itemized deductions are close to the standard deduction. I'll show an example of this. So again, here's just a hypothetical example of a married couple. So it's a lot of times we see numbers like this, right? You might have a mortgage, so you might have $10,000 of mortgage interest, your property taxes $3,000 for the year. You don't have enough medical expenses to exceed 7.5 of your adjusted gross income, so that's a zero. But then maybe you're tithing, you're given to some cause that you care for. Your charitable contributions are $12,000. Well, you add those all up, that's $25,000 of itemized deductions. The problem is, assuming this is a married couple older than 65 years old, remember the standard deduction for them is going to be nearly $28,000. So all these deductions, as the way it stands here, at the end of the day, you're really not getting a deduction on any of it. All right. So one strategy, which again, this works well if you're in a situation like this, where your itemized deductions are like just short of the standard deduction. All right. So what if we bunched deductions into 1 year instead? All right. So like mortgage interest, that's going to be mortgage interest. You can't prepay or delay that, but property taxes you can. All right. So many of you probably recently received your property tax bill, I know I did. If you look at the due date, it's actually not due until a little ways into 2022. Okay, so what you can actually do is you can wait until January to pay that. And then next year, when you receive the bill in the fall again, you could pay it right away then. So instead of having $3,000 in each year, you can bunch those together and have 6,000 in a single year. All right. The same goes with, with charitable contributions. If you just say in your mind, that, hey, we're committed to giving $12,000 a year. Instead, we're going to give $24,000 this year. And then, the following year, we're not going to give anything. Okay. So what this looks like in practice then. Okay, so we're going to pay 2 years of property taxes and 2 years of charitable contributions in a single year, right? So then they're both going to be zero the following year. So it looks a little more like this. Okay, so mortgage interest remains constant, property taxes just doubled, charitable contributions just doubled, right? So now all of a sudden, this couple has itemized deductions of $40,000. Now, $40,000 is obviously much higher than their standard deduction of about $28,000. So here at this point, now you can claim the itemized deduction. It's you have about a $12,000 more of deduction than you otherwise would have. And then the following year, obviously your deductions are going to be much lower, but now you just go back to claiming the standard deduction anyway. So you get 1 year of basically $12,000 more deductions than you would have had. Next year, you're back to normal. So this is an example of bunching itemized deductions. You could do this every other year. Yeah, it works really, really well for people that are close, as this example showed. Qualified charitable distributions. All right, so in order to do this, you first of all, you need to be older than 70 and a half years old. Can be a wonderful tax planning tool. The way it works, you have to give funds directly from your IRA to a qualified charity. Okay, which means you can't touch it. So you can't take a withdrawal into your personal checking account and then write a check to the church or wherever. Okay, like it needs to come directly from your IRA to a qualified charity. So what our clients do, we have them fill out, the name of the organization, the address, how much they want to do. Is this a monthly gift? Is it a one-time gift? Because the check needs to be sent directly from your custodian, right? So we use TD Ameritrade, Charles Schwab. It needs to be sent directly from them, from your IRA to the qualified charity. Okay, and so the way this works, and why this is so effective, especially for retirees, once you're 70 and a half years old, the qualified charitable distribution, it counts towards your required minimum distribution. Okay, so it counts towards that number, and it's not included in your income, right? So it really, you kill two birds with one stone, because obviously, if you take a distribution, right? So if your required minimum distribution is $30,000 and you take it, you personally take it all, well, that's going to be $30,000 more dollars of income on your tax return. If instead, you were going to be charitably inclined anyway, and maybe instead of taking the whole 30, you knew ahead of time, hey, you wanted to give 10,000 to some organization. Well, hey, you send that first 10,000 right to the organization. You take the 20, right? So the rest of your RMD, and that way your taxable income is only 20,000 instead of 30, and you fully satisfied your required minimum distribution. So it's a great planning tool, especially for those that take the standard deduction, right? This is another way kind of around, another planning tool around if your itemized deductions don't get you above the standard deduction, right? Because even if you take the standard deduction, like you're still going to have that big RMD that you need to get rid of every year after you're 72 years old. So if you're charitably inclined, if you're tithing anyway, like, hey, send that directly right from the IRA to the church. And you save a lot of money in taxes in doing so. Important point there. The charity organization must be a 501c3. Some will not qualify. Like the IRS has a list. Patrick and I, we help look up for people just to confirm that whatever their cause is, that it qualifies for qualified charitable distributions. Most do, but definitely something you want to double check before you start sending money off. Okay. All right, so why might I want to increase my taxable income? All right, so yeah, this might seem a little counterintuitive on the surface, but one way to think of it, many people, and sometimes this happens, like you might retire before like RMDs start, before Social Security start, but many times like you have this window of time, might be anywhere from 2 to 10 years where you're actually in a lower tax bracket than you will be in future years. Okay, so again, we see this a lot, like people are working, they have a really nice job, and then they retire. So their taxable income goes from a lot to all of a sudden you don't have earned income. So you're in a very, very low tax bracket because maybe you haven't started Social Security yet, you haven't started RMDs. Even if you have started those, by the way, like you want to analyze it, but so the idea and why you might want to increase, or so often we refer to it as accelerating your income into earlier years. Recognize that you bring on more income today, and therefore once RMDs start and Social Security starts, and you go into a much higher tax bracket, like you might have lost your window later on. So I know this is probably hard to see, but we use software where we project. So here's someone that retired age 64. I'm sure you can't see that, but this is kind of their expected lifetime, where at age 72, right? So and these are tax rates, by the way. The dark purple one's a federal, and the lighter one is a state tax. But you'll see, like currently they're in a pretty low tax bracket, and then once RMDs start, well, they're going to jump into a much higher bracket. Okay, so a lot of times what it makes sense to do is you kind of want to flatten this curve. So while you are in lower tax brackets, like it might be a really good time to move to move some of your traditional IRA money and get it over to the Roth side, right? So that's often referred to as a Roth conversion. Okay, so moving money from traditional to Roth. You pay the tax on the conversion, right? So of course you need to pay that tax, but once it's over on the Roth side, you're done being taxed, right? So if you're in that low tax bracket today, like it might be the best time ever to do it, right? And the other way to think of it, another benefit is on doing like a conversion is, remember, you have kind of that ticking time bomb. Some people call it like the tax torpedo. I've heard it referred to as before, because once RMDs start, you're going to be in a much higher tax bracket for some, and you're going to be paying a higher percentage. And if you do Roth conversions earlier, right, your IRA balance should be lower because you have more in Roth. And so if your IRA balance is lower, well, your RMDs should also be lower, right? Because RMDs are based off of your traditional IRA balance. So, however, big warnings here, and you'll notice a lot of these are things that we discussed earlier. Before you just blindly go and start doing, Roth conversions because you're in a lower tax bracket, there's a lot of things you want to look out for first. Okay, and this is, again, we really recommend that you reach out to your CPA, other financial professionals, because doing a Roth convert, it might make more of your Social Security taxed. at a higher rate. You could lose your Affordable Care Act, your Obamacare subsidy if you're on a health insurance plan prior to Medicare age. For some people, your Medicare could become more expensive based on your income. You might start paying that net investment income tax. Okay, so a lot of things to consider. It takes quite a deep analysis. Like we love nerding out to this stuff, but we either do a lot of due diligence on your own, or we think it's probably better to consult with your tax professional, someone else to help you look big picture, but also not make a mistake in the short term while you're doing that. All right, so just Roth conversions, how this works. I know I kind of touched on it a bit already, but again, basic premise: transfer a calculated amount of money from your traditional IRA to a Roth IRA, ideally before RMD age. Although we have a lot of clients who feel taxes are going to be even higher in the future. So we have a lot of clients that they satisfy their RMD, and then we're still converting more at this point. But pay the taxes this year, ideally at a lower rate is the idea. Conversions reduce the amount of your traditional IRA balance, thus lowering future RMD amounts. Also kind of a legacy planning tool as well. We help a lot of clients that it's pretty apparent that there's a good chance they're not going to spend it all in their lifetime, right? And so Roth IRA money, once it's over in your Roth, it enjoys tax-free interest, dividends, growth. Like when you withdraw it sometime in the future, it's tax-free, whether it's in your lifetime or your beneficiary's lifetime, right? So, and there's no RMDs, so it's a great benefit, both in your lifetime as well as your kids. So, and then again, just please consult with professionals before taking action. All right, another reason to possibly accelerate income, or not a reason, but a method, kind of a strategy of accelerating income. Kind of going back to that tax map, a lot of people don't know that there's a 0% tax rate window for long-term capital gains. So many times we'll see, and again, a lot of times this happens like right when someone retires, where maybe they had a lot of income, they retired, now they have like zero earned income, and you might have like this big window where maybe you have like stock that's been appreciating for a bunch of years, and now all of a sudden like you're in a 0% long-term capital gains rate window in a non-qualified account. Like so just filling up these buckets, or that 0% bracket makes a lot of sense. So that's something to consider. A lot of times we will work this alongside of Roth conversions, right? So we might do one or the other, or sometimes both, right? So kind of combining the way these work, a long-term capital gain, as well as a Roth conversion. So same warnings as when you're doing Roth conversions. Okay, and I promise this is my last warning, but I do want to make sure, because it's mistakes can easily be made in this field. So long-term capital gains, recognizing that income can also push adjusted gross incomes over thresholds that increase insurance costs, right? So just want to be careful on that. Hopefully this wasn't too overwhelming. If you can't tell, we're really big nerds on this, and we like geeking out, and we have some fun software that helps solve these problems. Hopefully you've found some of this. I've tried to keep this very generic, but in terms of tax loss harvesting and Roth conversions and long-term capital gains. But if you would like to speak with us. You know, we always offer, you know, two sit downs complimentary. If you're looking for a little guidance, just to kind of point you in the right direction, you know, we'd be happy to have a call and kind of show you what your tax map looks like. You know, possibly what your kind of lifetime tax situation might look like given IRA balances and so forth. You know, so we do that all complimentary the first couple times. So if you have any interest in that, just a little email address down here, info@oceansideadvisors.com. We would love to hear from you. And from there, I think we'll just open it up to a couple questions.
Yeah, we had a lot of good ones come in here. Try and get to a few. If we don't get to any of the questions, Johann or I will reach out directly and answer your question. First one, RMDs for IRAs. If you're going to use the money during the year, is it better to take a lump sum at the beginning of the year?
Yeah, good question. So theoretically, and I preface this with theoretically, it makes sense to take it actually at the end of the year. And so unless you need the income, you know, unless you need the income to live off of for that year, which a lot of people we help do, but theoretically it makes sense to wait to the end of the year. The reason being, more years than not, you know, about 75 to 80% of the time, markets go up throughout the year. So by waiting to November or December, we usually send the majority of RMDs. By waiting to the end of the year, you just give yourself a longer tax deferred treatment of those funds. So hopefully they can grow tax free before the withdrawal. So we would prefer, again, theoretically to wait to the end of the year. But in practice, like a lot of our clients, we're sending monthly distributions. So it really depends on your situation.
Good answer. Not surprisingly, I agree with everything you just said. Second question here, and this is a good one. Is there a maximum amount for the QCD?
Yeah, and Patrick, you can fact check me. I'm pretty sure it's $100,000 a year.
It is.
So,
yeah, per person.
So each spouse could do $100,000.
So each spouse could do 100,000. Yeah. And then I think this is a good one to finish up on here. If the new bill gets passed, what are the main items we need to worry about?
Yeah, really good question. And then we'll see what the final bill looks like. And again, kind of, I alluded to it at the beginning of the call. Like the initial draft was pretty scary. There were a number of things in there: higher tax rates, higher capital gains rates. Since then, it's been extremely watered down to the point where, for most Americans, the new bill, at least as it stands now, it shouldn't have extremely adverse impacts on most people. Like a couple things to look out for would be, you know, the latest draft, unfortunately, it looks like they're going to do away with what's called backdoor Roth contributions. Okay, so not conversions, but contributions. Contributions we haven't touched on at all today. Backdoor, you know, Roth contributions, but for some of our higher earning professionals that are still working, that's kind of a bummer. So backdoor Roths might be out of the game. We'll see. S corp. So any self-employed S corp owners, they're going to start including S corp profits are going to be included in that net investment income, that 3.8% tax, which isn't awesome at certain income levels. That starts getting phased in, and then the other piece, it'll be interesting, but the SALT cap. So again, that state and local so like income and property taxes, currently capped at $10,000. They're looking to increase that to $72,000 or $80,000 a year for the last two numbers that I saw thrown around. We'll see what it ends up being, but that was primarily being pushed by some of the states that have really high property taxes, right? Like a New York, New Jersey, California, because obviously the many of those people were not getting credit for deductions at all. The state and local, those really high taxes. So yeah, I think that's we'll see, and of course we'll keep you very up. We look for things every day. We try to do our best to keep people updated, and if they need to act on anything. But as I've said previously, like, people can spend a lot of time and energy, wasted energy, kind of speculating on what may or may not happen. And so I much prefer to, hey, let's wait until it's becomes law, and then do our best to plan around it and make adjustments. So yeah. Anything else?
Yeah, we can do one more. When tax loss harvesting, are you trying to time the market?
No. So maybe I could have been more clear on this. So tax loss harvesting, important point, like you need to sell the position just to recognize the loss. Okay. But importantly, like, immediately after you sell it, you want to find a position that can go back up with the market, right? So we're not at all trying to market time. We're just trying to effectively capture that $3,000 loss for that person's tax return, and immediate replace it. So it's not market timing. It's just tax strategy. I hope that answered it. I think that's what they're getting at, the question.
Yeah, I think so too.
And yeah, I see there's a handful of other questions coming in here. I think it might make most sense. We can just maybe respond to some of these other questions via email. Some of these are pretty specific. So if we didn't get to your question today, we'll reach out to you in an email, and then of course, please let us know. If you just reach out to us, info@oceansideadvisors.com, and we'd be happy to have a call or have you to the office to talk about your situation a little bit more. We'd be happy to do that. We like doing that. So with that, we want to thank you for joining us. Happy Thanksgiving to you and your families. We look forward to seeing a lot of you at the client appreciation event. So hockey games coming up here Friday, the December 3rd, and Saturday the 4th. If you haven't RSVP'd, please do. We'd love to see you one of those nights. This is going to be our last webinar of 2021. We're going to be pretty busy with some of this tax planning between now and then, as well as I think all of us at the office here, we like to try to spend some good time with family. So we wish everyone a happy Thanksgiving, and yeah, thanks for hanging out, and we'll talk to you soon.